That's what I agree with. This is what I don't agree with, and it's the fun premise of your book. I don't agree with it, and that is that Fannie Mae and Freddie Mac's affordable housing goals are the principal cause for the financial crisis. I don't agree. Maybe if I had to list the top 10 things, it might make it onto the list, but I'm not even sure it would. It might be number 10. It might not even make it on the list. I think to explain the financial crisis, you have to explain a number of facts, and you take a crack at it, but there are three key facts that need to be explained very, very clearly, particularly in the context of your premise that the affordable housing goals were at the root of the crisis. One is that Fannie Mae and Freddie Mac's share of the mortgage market declined precipitously between 2003 and 2006. And that's the period, in my view, when the bubble was inflating. That if you look at Federal Reserve flow of funds data, now financial accounts data, the share of debt that Fannie and Freddie backed, mortgage debt, single-family residential mortgage debt that Fannie and Freddie backed, was peaked at 43%. And I know these numbers because I looked at them. I can even tell you to the second decimal point, but I'll round. 43% second half of 2003. It fell and hit bottom in the second half of 2006 at 35%. And by the way, 35% was the share of the mortgage market that Fannie and Freddie backed in 1993. When the affordable housing goals were first being implemented. And it was really the bubble in the housing market, and you can actually see it in the chart you showed, inflated in 2004, 2005, and in 2006. And that was a period when Fannie Mae and Freddie Mac were exiting the mortgage market. They were being pushed out of the mortgage market. It was really, I believe in Occam's law, that the most straightforward explanation is the right one, and if you just look at the share of mortgage debt that was backed by private RMBS, rose in tandem with the decline in the share that was backed by Fannie Mae and Freddie Mac. And by the way, I am an employee of the Moody's organization. It's not. I didn't cause any of this. I had nothing to do with it. I sold my company to them at the peak, so I had nothing to do with it. But I am Wall Street in front of you, right here. I am the. The second fact is, and again, you take a crack at it, but I think not convincingly. There were housing bubbles in other parts of the world, in the UK, in Ireland, Spain. If you talk to the Canadians, they'll debate you whether they have a bubble, but feels like a bubble slightly. Australia, and if Fannie and Freddie's affordable housing goals were at the root of the problem, then why these bubbles forming overseas? Now, you make a good point that those bubbles didn't crater, crash, and take out the economy and lots of those other economies, but it did in the UK, Ireland, and Spain, and those are the same markets where we had a thriving private label securities market. It didn't take the mortgage market out, the economy out in Canada and Australia, because those are systems that are dominated by 4 or 5 very large banking institutions. They make all the loans, they hold all the credit risk. They are highly regulated institutions. There is no private label securities market to speak of in those markets. So that's a second fact that needs to be explained. The third is, if you look at the realized losses on residential mortgages from 2006 to 2013, I don't have full year data for 2014, so let's look at 06, 2013, and look at realized losses, so get around the mark-to-market accounting issues, relative to debt outstanding. You'll see that the total losses, realized losses over that period, were 9–10%. So 1 in 10 dollars of mortgage debt outstanding that were originated in the bubble essentially got written off by the system, the financial system. And obviously that's a lot of money about $1 trillion worth, and you have to write off $1 trillion. That goes a long way to explaining why the system choked on it. And then you look at it, the losses, the realized losses by who held the credit risk. Well, depository institutions, the banks, had a 6% realized loss. Fannie Mae and Freddie Mac had a 3% realized loss, 3%. If you throw in the MIs, the PMIs, you're getting up to 4, maybe 4.5%. Private label securities have had a realized loss, and this is hard data because I have the data. You know, this is pools of securities. I have it. Security by security is 23%. 23%. So, you know, you can do the forensic accounting, and Ed does a really nice job of that and deserves a lot of credit. But at the end of the day, what really matters is losses. You know, where are the losses? And they're not in Fannie Mae and Freddie Mac. So that needs to be explained. So let me end by saying, in my view, there are many reasons for the crisis, and I think you really could literally put a list together, a top 10 list. There's that many causes. There are lots of blame to go around. Again, none of it my fault, but you know, lots of blame to go around. But I put 3 things at the top of the list. One is a surfeit of global saving. You know, China, emerging economies were coming onto the scene after China entered into the WTO in 2000. Huge current account surpluses. That money had to be reinvested, and that goes to explaining why you had and I sympathize to some degree with what you're saying about the Fed, but you also had tremendous capital flows going into all parts of the fixed income market, equity market. That's why junk corporate spreads got to 250 basis points, why spreads in every asset category got compressed. And that global surfeit of global savings is the fodder for the crisis, for the egregious mortgage lending. The second is the private label securities market was fundamentally broken at the core, from the originator to the investment bank that issued the securities, to the rating agencies that rated the securities, and we can talk about every aspect of this, and we can in detail with regard to how it was broken, to the investors themselves. The system, no one had a clear understanding of how the private label securities market system worked from A to Z, and it was fundamentally broken. So we took this surfeit of global saving, we pumped it through the securitization machine, and we got a mess because it was literally broken. And finally, thirdly, in my view, it's a regulatory failure on lots of levels. I mean, if you look at the originators who were most egregious and messed things up, they were not regulated at the federal level. Most of them were very lightly regulated at the state level. AmeriQuest, New Century Financial, even Countrywide. And the regulatory thinking at the time was we should not address these problems from a macro-prudential perspective. Now that has changed, and Dodd-Frank, you know, embodies that. And I know a lot of work Alex has been doing is in this regard with the use of LTVs and restricting LTVs. And it's used in other countries now in terms of macro-prudential policy. But that was not part of the thinking. And to some degree, the rating agencies themselves were outsourced regulators. You know, that they were required to regulate, and they didn't. They failed. So if I had to list the top 3 things, those are the 3 things. And those 3 things, if you think about it, explain my 3 facts, I think, better in a more consistent and coherent way. And I think at the end of the day, again, I don't think the affordable housing goals, they might make it on the list, but it would be at the very bottom of the list. Thank you.
Then, Mark, you talked about, and here's, I may have lost this number somewhere, but I think you said Fannie and Freddie's losses were 3%. You did say that? Realized losses were 3%. All right. I don't know how that can work. What we know is that the government actually provided about $185, $186 billion to Fannie and Freddie after they failed in order to keep them solvent. And before they failed, they had about $100 billion in capital. Fannie had about 60, Freddie had about 40. So really the total loss was something like $280 billion. Well, Well, they were realized losses in the sense that,
They weren't ever realized. It was goes to the market. And they were insolvent.
You got it, yes.
yeah,
Sorry. That's the distinction between realized losses and unrealized. They were insolvent on a mark-to-market basis. That's what the capital hole was, right? Based on the mark-to-market account.
because as I said, in their 2008 financial report, their credit report, they showed actual losses, these were not mark-to-market losses, these were actual losses of 81% from these mortgages. And that's why the government had to reimburse them for all of these losses. Now, this was not a 3% loss. This was in the case of if there were $280 billion in total losses, including the capital and then the amount that they lost after that, and the government had to reimburse, even if we take just the amount that the government had to reimburse between 2008 and 2012, if we just took that amount, that's $185 billion, of which maybe 60% was probably Fannie, and about 40% was Freddie. That's still not 3% of realized losses, but those were actually realized losses because they occurred after the financial crisis and occurred, these were the evictions and defaults that were the cause of the losses that Fannie and Freddie were realizing. It wasn't as great as people anticipated, but it wasn't 3%. It was much, much larger than that. So we have a little disagreement on the facts. I'd love to see what you're relying on, but I find it very difficult to imagine it was only 3%. And we have so much other data that shows that the losses that Fannie and Freddie suffered were the result of failures all over the country that drove down housing prices.
Thank you, Peter. Now we're going, Mark, your turn again.
Well, I think it's very encouraging that we're here debating data. Great. So I'll share with you, and we'll have a debate and discussion. And I feel pretty convicted in my numbers, but you do as well. And that's wonderful.